Okay, let's dive in. We've got the first quarter 2025 financial results and the shareholder letter from RH, formerly Restoration Hardware. And it paints quite a picture.
It really does. It's way more than just the numbers. It feels like a full strategic manifesto from the leadership team.
Exactly. So our mission here isn't just to, read the report to you. We want to cut through the noise.
Yeah, pull out the key financial bits.
Right, and understand the strategic moves they're making, especially given the challenging market they keep talking about.
And get to those core insights that are kind of hiding in all the detail.
Exactly. We want this deep dive to give you that well-informed shortcut.
Okay, let's start with those headline Q1 2025 numbers then. Top line first.
Right.
Net revenue saw a pretty solid increase, up 12% year over year. That's $814 million compared to $727 million last year.
And that flowed through to the bottom line.
Yeah.
Big swing there.
Huge swing. They went from a GAAP net loss last year, about $3.6 million, to a GAAP net income of $8 million this quarter.
Why? No.
It's a significant improvement. And, if you look at their adjusted net income, which kind of strips out some one-off things for a clearer operational picture, that also flipped positive. It was $2.6 million income this year versus a $7.3 million loss last year.
So financially, definitely a clear year-over-year rebound in Q1. What about profitability? Margins?
Okay, so GAAP operating margin was 6.9%. Adjusted operating margin was basically flat at 7.0%.
Right.
And adjusted EBITDA margin, that's, earnings before interest, taxes, depreciation, amortization, the common profitability measure that landed at 13.1%.
Okay. And crucially, cash flow. Did they generate cash?
They did. Positive free cash flow this quarter, $34 million, which is a healthy turnaround from losing $10.1 million last year.
That's a good sign.
But what's really striking is how they immediately frame these results in the letter. They really emphasize they're getting these numbers despite, and they say this explicitly, the polarizing impact of tariff uncertainty and the worst housing market in almost 50 years.
Hang on. Worst housing market in almost 50 years.
Uh.
That's a huge statement. How are they backing that up?
They give a very specific comparison. They point out that existing home sales for 2024 are tracking around 4.06 million,
Right.
with a U.S. population today of 341 million. Now, compare that to 1978.
Right.
Back then, sales were actually slightly higher, 4.09 million, but the population was way smaller, just 223 million.
So fewer sales per person today.
Exactly. By their math, it underscores just how tough the environment they feel they're operating in is.
Okay, so given that tough backdrop they're painting, how does the leadership view their own performance then?
Well, they basically say they believe they're performing at a level you'd expect in a strong market.
Interesting. Why? What's the logic?
They put it down to their strategic philosophy. They call it an inch wide and a mile deep.
An inch wide and a mile deep. I like that. What does it mean in practice?
It means investing with a really focused, narrow scope, but going really deep. Long-term view, not spreading themselves thin.
Right, intense focus.
Exactly. And they actually bring in a Warren Buffett quote here. You know the one about dark clouds raining gold?
Oh, yeah. Need washtubs, not teaspoons.
That's the one. And they see their moves as a washtub bet on ourselves.
How are they applying that washtub bet? What are the big bets?
Well, they point to their past stock buybacks. Remember, they bought back $2.2 billion. That was like 30% of their shares during the 2022-23 downturn.
Okay, so putting serious money behind their own stock when it was down, that fits.
Right. And they're making another move now that feels pretty aggressive for a downturn. They're boosting their membership discount.
Oh, yeah. From what to what?
From 25% up to 30%. And they frame it as, an offensive move to grab market share while maybe others are pulling back.
And this inch-wide, mile-deep thing, it's not just financial strategy, is it? It seems to be driving these massive physical investments, especially the global expansion they talk so much about in the letter.
Oh, absolutely. They spend a lot of time on Europe. They highlight the RH England Gallery's second-year demand trends there.
Now, that was one of the countryside, right? Seemed a bit risky to some people.
Exactly. A bit counterintuitive. But Q1 demand there jumped 47%. Online demand up 44%.
Wow, 47%. That's pretty impressive growth for a location that wasn't a sure bet.
Yeah. And they're projecting that England Gallery could hit like $37 to $39 million in gallery demand, plus another $8 million online in its second full year.
Okay.
And this success, in what they admit is a remote spot, leads them to ask this provocative question.
Which is?
Basically, If England, with a pretty small local population, a couple hours from London, can do that, what could a gallery in London's Mayfair, right in the middle of 9.7 million people, possibly achieve?
Ah, okay. So they're using the England success as proof that the demand for this immersive experience model is real, and it scales up massively in prime urban spots.
That's exactly it. They explain the whole idea behind the remote England location was they believe doing something extraordinary and remarkable cuts through the noise, creates real buzz.
Hard to monetize ordinary, as they say.
Precisely. It wasn't just opening a store. It was about creating a destination, making a statement.
And it seems to be working elsewhere in Europe, too.
Yeah, they mentioned demand growth of 60% in Q1 across their comparable galleries, places like Munich, Dusseldorf, and continued acceleration in the newer, non-comparable ones like Brussels and Madrid.
Okay, so the momentum seems broad.
Yeah.
And the next really big statement piece looks like Paris.
Oh, yeah. RH Paris.
Huh.
On the Champs-Élysées, no less. The letter paints this picture of a super immersive place, blurring lines between retail, hospitality.
Right.
Think like 6 floors, dramatic atrium, glass elevator, multiple restaurants, one overlooking a garden, another on the rooftop with Eiffel Tower views.
Wow. Multiple restaurants in one location.
It's not just about selling sofas, right? It's this whole aspirational sensory experience.
Sounds like a complete luxury world they're building.
Yeah.
And that opens soon.
Early September, time for Maison et Objet. And then London and Milan are planned for 2026.
And this is all part of a bigger plan to speed things up.
Yeah, they state a goal to accelerate the platform expansion, aiming for 7 to 9 new galleries per year globally, plus other smaller format spots.
7 to 9 a year, that's ambitious.
And this.
Especially given the market headwinds they mentioned.
It is. They call international expansion an inflection point, a multi-billion-dollar opportunity. They even estimate the global market opportunity at $7 to $10 trillion. They're definitely taking that inch-wide, mile-deep idea global. And building on that, they're also trying to elevate the product and the platform itself beyond just adding new locations.
Right. They talked about recent product launches, the 2025 RH Outdoor Sourcebook.
Yep, that came out early Feb. New collections, better stock levels, they said. But interestingly, they noted sales slowed down after the tariffs hit. Ah, tariffs again.
Yeah, which led them to temporarily bump the membership discount just for outdoor, up to 35%.
Okay, so a specific tactical response to tariffs hitting a specific category? Makes sense.
Exactly. Then the RH Interiors book came mid-Feb. They said the response was good despite, tariff volatility. And the RH Modern Sourcebook just dropped. 18 new collections. And they introduced this new aesthetic called Japandi.
Japandi, oh, right. The mix of Japanese minimalism and Scandinavian style. Very calm vibe.
That's the one. They also mentioned, though, that a significant new brand extension planned for this fall 2025, it's delayed, pushed to spring 2026.
Why? Let me guess. Tariffs.
You got it. Tariff uncertainty. This new brand was supposed to include a source book and 3 freestanding galleries, specific locations mentioned. San Francisco, West Hollywood, and Greenwich, Connecticut.
So those tariffs aren't just messing with current sales figures, they're actually delaying major strategic rollouts. Correct. And these new physical spaces, like the ones for the delayed brand and their existing galleries, they're absolutely key to the whole strategy.
Right.
They keep talking about creating inspiring and immersive physical experiences, blurring the lines, residential, retail, indoor, outdoor, home, hospitality.
With things like garden courtyards, rooftop restaurants, the wine bar.
All fundamental. And that Aventura Mall story they tell in the letter, it really hits home how powerful they think these transformed spaces are.
Remind me of that.
They took a store in Aventura Mall, Florida, doing $2 million a year in sales.
Okay.
In the exact same space, they turned it into a gallery. And it started doing $44 million a year.
$44 million from 2 in same spot.
Yeah. And now their plan is to build a $100 million plus design compound there eventually. It just shows the scale of physical change and the revenue jump they believe it drives.
And this idea of these immersive places, Aventura, Paris, England, it sounds like that's just one piece of an even bigger puzzle. They talk about building a whole ecosystem.
Right. This is where their ambition really goes way beyond just selling nice furniture. Their stated aim in the letter is to become a global thought leader, taste, and placemaker.
Okay.
By building this ecosystem of products, places, services, and spaces.
It really does sound like they're trying to sell an entire luxury lifestyle, not just stuff for your house.
That seems to be exactly the insight. It's like our customer lives a luxury life that extends beyond their 4 walls. So to really own that customer, we need to offer luxury everywhere they are. Travel, leisure, dining.
Which explains the huge push into hospitality.
Totally. The restaurants and the galleries, sure, they say those drive energy awareness, profitable customer acquisition. But also the standalone guest houses, RH Yountville and Napper, the private jets RH1 and RH2, even a luxury yacht RH3.
Private jets and a yacht.
Okay, yeah.
That really makes you rethink what a home furnishings company even means anymore. It's something else entirely.
And they flat out say their goal is to create a new market in the North American hotel industry, focused on privacy, luxury. It's about extending that brand loyalty way beyond the home.
And there were other business extensions mentioned too, right? Briefly.
Yeah, briefly. A global bespoke interior design arm doing million-dollar-plus projects.
Yeah.
A contract hospitality business for commercial clients. And then future plans for like a consumer-facing architecture and design platform within the galleries, and even launching RH residences.
So theoretically, you could furnish your home with RH, have RH design it, live in an RH building, fly on an RH jet, stay at an RH guest house, eat at an RH restaurant. It's like they want to build a complete RH universe.
That seems to be the vision for the world of RH. They say they'll bring this ecosystem to life digitally too, and they're introducing something called RH Media.
Okay, let's circle back to those tariffs though, because they keep coming up in the letter as a major headwind.
Yeah, definitely. The uncertainty, the impact, it's clearly a big challenge they're grappling with.
So what are they actually doing about it? What are the concrete steps?
They're moving sourcing out of China aggressively. They expect receipts from China to drop from 16% in Q1 down to just 2% by Q4 this year.
Wow, that's fast. Who picks up the cost?
They say vendors are absorbing some of it, and they're also reshoring or nearshoring. Upholstered furniture is moving to their own factory in North Carolina.
Okay.
The goal is 52% U.S. production, 21% from Italy by the end of this fiscal year.
That is a massive supply chain shift in a very short time.
It really is.
Right.
But they also note that even with these moves, things can happen. They specifically mention significant and unexpected Liberation Day tariffs announced on April 2nd.
Liberation Day tariffs. Okay. What was the impact?
Disrupted shipments globally, messed with the resourcing efforts. They estimate it'll knock about 6 points off Q2 revenue growth.
Ouch.
Though they do anticipate recovering that hit in the second half of the year.
Okay, so even with proactive shifts, external shocks can still cause immediate pain.
Exactly. But despite all that uncertainty and disruption, the letter repeats they're confident they can compete and execute the strategy.
So looking forward then, what's the actual financial outlook they provided?
For the rest of the year.
Okay, for the full fiscal year 2025, and this assumes current tariffs stay in place,
Right.
they're guiding for revenue growth between 10% and 13%. Adjusted operating margin between 14% and 15%.
Okay.
Adjusted EBITDA margin 20% to 21%. And free cash flow landing somewhere between $250 million and $350 million.
And what about just for Q2, the current quarter?
For Q2, they forecast revenue growth of 8% to 10%, adjusted operating margin 15% to 16%, and adjusted EBITDA margin 20.5% to 21.5%. And it's important they note that the Q2 operating margin guidance includes a hit about 180 basis points or 1.8% negative impact from investment.
And investments.
International expansion startup costs, building out that whole ecosystem.
Got it. They also talked about their debt, didn't they? Which came mainly from those big stock buybacks earlier. Right. They address it. The plan seems to be managing it by selling off some assets when the time is right, opportunistically.
Like what kind of assets?
They estimate they have about $500 million in equity value in real estate they could monetize, and maybe $200 to $300 million at cost in excess inventory they can sell down.
Okay, so ways to generate cash without issuing stock. And what about future spending? Capital expenditures.
They actually project their adjusted CapEx will decrease over the next few years. They forecast $250 million in 2026, then dropping to $200 million in 2027 and beyond.
So this suggests they see the current period as kind of the peak investment push.
Seems like it. Like the heavy lifting on expansion happens now, and then capital needs should ease up a bit. They tie it back to their confidence again, investing heavily for growth now, but with a plan to reduce debt and interest costs over time.
And finally, the letter gets pretty philosophical when it talks about their company culture.
It really does. They describe it as being built on leadership, innovation, collaboration, using phrases like, none of us are smarter than all of us, and getting all the brains in the game and the egos out of the room. And they emphasize this idea of Thinking until it hurts.
Thinking until it hurts. That intensity, that collaboration, and feels like you'd need that to even attempt the kind of stuff they're talking about.
Absolutely. And then they bring in that really famous Theodore Roosevelt quote, the man in the arena speech.
Ah, the Sorbonne speech. How do they connect that quote to, selling high-end furniture and running hotels?
They use it very deliberately to frame their whole journey, transforming a nearly bankrupt business into this luxury brand.
Right.
The quote, it's all about the credit belonging to the person actually in the arena, face marred by dust and sweat and blood,
Yeah.
who messes up, fails, but keeps striving.
As opposed to the critic on the sidelines.
Exactly. Who knows neither victory nor defeat. They basically say, that's us. Our journey, the challenges, the mistakes, the scar tissue, that's what being in the arena looks like.
And they literally ask in the letter, are we a part of the lunatic fringe?
Yeah. And they answer it using Roosevelt, suggesting that if being on the lunatic fringe means choosing to be in that arena, daring greatly, facing the critics, pursuing something big, even with the risk of failure, then yeah, put us in that arena. It's a very philosophical justification for taking huge risks and aiming incredibly high.
So let's try and wrap this deep dive up then. The picture from this letter is, well, it's pretty compelling, isn't it? You've got a company saying, look, we're navigating one of the toughest housing markets in 50 years.
According to them.
According to them. But at the same time, they're not just surviving, they're making these huge, really aggressive bets on long-term global growth.
Absolutely. They're not playing defense. They're actively pushing forward with this massive vision, building this sprawling luxury ecosystem that goes way beyond just retail.
Into hospitality, design, private travel, the whole lifestyle, all based on that inch-wide, mile-deep idea.
Right. And doing it with this very distinct, almost defiant mindset, that man in the arena philosophy, even while dealing with very real immediate headaches like these tariffs that are messing with their plans right now.
It's definitely a story of huge ambition meeting significant headwinds.
So here's maybe a final thought for you listening to this. Consider the sheer scale, the audacity of what they're trying to do here.
Yeah.
Taking a company known for furniture and turning it into this global brand encompassing hospitality design, potentially billion-dollar gallery compounds, private jets, yachts.
It's kind of mind-bending.
It is. So how does that extreme focus on the experience, on selling a whole luxury lifestyle, potentially redefine what a home furnishings company even is? And what could that signal for other industries that are trying to build deeper, more immersive connections with their own customers?
And maybe thinking about that man in the arena quote they leaned on so heavily, what does it really cost for a company, for anyone, to choose to be in that arena, striving, daring, risking failure like that? What are the real rewards, but also what are those inevitable marks, the dust, the sweat, the blood that they talk about? Something to chew on.